Good evening, everybody. My name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using closed-end funds and an income-focused strategy. This isn't polished, it's not scripted, and it's definitely not herd thinking. We don't chase headlines, we navigate markets. I'm not a financial advisor, I am a strategist. So I go where the data leads, even when that means walking alone. Welcome back. Normally I make weekly videos, but it's been 2 weeks since the last video, and quite honestly, I'm a little rusty. This is my second attempt tonight to do this. So let's reset. Remember our four economic bodies of water: currents, waves, ripples, and tides. The headlines have changed. The currents have not. The US economy is still attracting capital, and the deeper financial currents are still flowing in the same direction. Bonds and bond proxies, end-to-end energy, technology infrastructure, and real estate. And the surface looks chaotic, but the deeper currents are still pulling us forward. So let's get into this. Why does the market look broken, even though it isn't? Well, most people get it wrong is probably not the right way to say it, but most people interpret the data wrong. They think volatility means that something is breaking, but it doesn't. It means they don't understand what they're looking at. If you look at oil, the narrative says energy is in crisis. Prices are spiking, conflict is rising. But that's not the full picture. The US is largely energy independent. Domestic supply does not come from Iran. So why are prices rising? Because the market isn't reacting to logistics, it's reacting to fear. And when understanding is absent, fear fills the gap. And that's not just oil, that's the entire market right now. So while oil bubbles and the Iran situation draws our attention, something bigger is happening under the surface. AI is compressing the economy, not destroying it, compressing it. Companies are becoming more efficient. Costs are dropping. Headcounts are shrinking. Sounds good, right? Costs are dropping. Sounds great. But the problem is when productivity rises, spending doesn't rise with it. That's the disconnect. It looks like growth, but it doesn't feel like growth. And markets and investors are struggling to price that in. So what happens? Volatility, confusion, overreaction. But here's what the market is quietly telling us. So, in addition to oil, GDP, and AI, now layer in those geopolitics. Tensions in the Middle East, shipping concerns, energy headlines. The herd sees instability. But if you take a step back and see the bigger picture, oil is still moving, supply chains are adapting, and global players are stepping in to stabilize the flow. That isn't collapse, it's adjustment. And markets always overreact during adjustment phases. So let's connect events. Let's connect those events and the adjustment to the credit market. There's a growing narrative around private credit crisis. But if you look closer, it's not 2008. It's opacity meeting reality. Private credit looks stable because it isn't priced daily. But that stability can be misleading. When cracks show, they show quickly. And that's why capital is starting to shift. And it's shifting away from opaque structures and toward transparent income vehicles, like closed-end funds holding publicly traded bonds. And that brings us to BDCs. And it's where a lot of investors are about to get caught off guard. Nice. BDCs thrive in rising rate environments, but we're not in that environment anymore. If rates fall, their income gets squeezed, their borrowers get weaker, and their risk increases. And what most people are missing is the same companies being disrupted by AI are the companies BDCs are lending to. That's not a great combination. And it isn't panic territory, but it's not a blind hold either. So if you want more information on that concept, check out my recent conversation with ChatGPT on FSCO, which I've recently revisited and quite honestly had a deeper conversation with Chat, who forced me to justify my own system, which is always an interesting conversation. So now we come full circle. So why do bonds keep showing up as the strongest current? Because everything we just walked through points in the same direction. AI is deflationary. Geopolitical tension drives safety demand. Credit markets are showing early stress, and rate cuts are becoming more likely. And when rates fall, bond prices rise. That's the connection. Not opinion, not prediction, just the alignment. So go back to the core idea. Your portfolio is a moving vehicle. If it's sitting still, it produces nothing. But if you place it in the right current, it moves forward and produces income while doing it. That's the goal. Not reacting to the waves, not chasing the headlines, not looking for reflections from yesterday's market. We want positioning inside the current. So as we get into the weekly snapshot, remember that this is our filter set: bonds and bond proxies, end to end energy, technology, infrastructure, and real estate. Now I'm going to do something that's almost unheard of. I'm going to call myself out. BDCs are mixed into bond proxies, but they're dirtier bond proxies, or they're dirtier than bonds, however you want to say that. BDCs are leveraged lenders to riskier borrowers with floating rate exposure and credit risk sensitivity. That's not a bond. So here's what actually happens in a falling rate environment. For bonds, rates go down, prices go up. Clear mechanical relationship. A very simple if this, then that. BDCs, when rates go down, loan yields go down. Borrower stress may increase, especially in disruption cycles or adjustment phases. That means net income gets squeezed. So instead of rates going down and you getting a tailwind in bonds, sometimes you get rates down and then you get a margin compression and you have a rising credit risk, like what we're seeing right now. That's not bond-like behavior. People go to bonds for safety, not risk. So as it pertains to me and my portfolio, FSCO remains on watch as a tactical hold. And I've said this before, and I will say it again. I love FSCO, and BRW, but I've realized as much as I love them in my portfolio, I've become almost emotionally attached to them. And that's dangerous. So FSCO remains on watch as a tactical hold, not a core position. And its status will be determined strictly by the data over the coming weeks. I'm tracking three key signals, first of which is the overall NAV trend, net asset value trend. If stabilization fails over a defined window, we'll say 2 to 8 weeks, or simply fails to show meaningful improvement, that becomes an exit trigger. Second is discount behavior. If the discount does not begin to tighten alongside a stable or improving net asset value, it signals a lack of market confidence and reinforces that rotation. And third is sector deterioration. Any additional dividend pressure or weakening trends across the BDC sector indicates the credit cycle is turning, which is justifying a move out of the position. And at this stage, FSCO is no longer an accumulation play, but a monitored position that must either prove strength through improving data or be replaced by a higher conviction opportunity. And I'm still 50-50. So I say this for you just as much as I say it for me. If you're not willing to park money into something outside of those four currents, can you justify holding it in your portfolio long term or short term? I understand cyclical investing and cyclical holds, but cyclical holds prevent you from deploying capital into actively flowing currents. So, whatever it is you're holding on to, and for whatever reasons, if it's not logical and data driven, it's probably emotional. And emotional fund attachments will hold you back. With that baseline in place, and with that threshold of understanding in place, here are the top funds for this week and why they made the list. And we're going to start with six, but we're going to call the list. Let's see, how can I share this? They've changed the settings in Zoom a little bit. So we're going to start with six, but we're going to change this really quick. So if we are prioritizing market currents, that means we're looking at bonds and bonds proxies, maybe not BDCs in that proxy list, but bonds and bonds proxies, end-to-end energy, real estate, and tech infrastructure. It's really hard to justify something outside of those currents. Now, you could look at USA and ASG as tech infrastructure funds based on the companies they hold and the ongoing software development, et cetera, et cetera. They're great dollar cost average buys, but pretty much everything on the list is a great dollar cost average buy at this point. So if we're prioritizing currents, it's really hard to pick something that's outside the current, even though it's a great dollar cost average buy, even though it's a great yield buy. But I left it on the list for this reason. USA and ASG are great dollar cost average buys for me. They pay in June. The ex dividend date is normally the middle of April. So, based on timing, you could make a decent logical justification for picking up USA and ASG right now. But on my end of things, if I am prioritizing current and if bond is still the leading current, followed by those other three, it's hard to justify leaving those two on the list, knowing that it's not a full commitment inside of tech infrastructure. So on my end of things, they don't stay on the list. These are the two funds, like the strong bond contenders. These are the bond proxy contenders. IGR is the REIT, and it's a global REIT. And they lock in more than just your traditional uh, strip mall and housing project. HGLB is a mix of everything. It's become a mix of everything, maybe not quite everything, but it definitely ticks the boxes. So those would be the top four. Now, me personally, I'm not investing tomorrow. Um, quite honestly, I need to sleep and really deep think if I'm going to keep FSCO or not. Um, Emotionally, I've got this hope tied to it that it'll come back, and the data says otherwise. And I've got to resolve those things and not simply do a knee jerk sell. Um, but that's on me. But if I was buying tomorrow, these would be my top four. If you were going to nail me down to just one, I would probably pick DSL for two reasons. And no, not based on the yield. I mean, that's a pretty comparable yield. Uh, the current discount on DSL is greater than PDO's. You know, PDO is discounted at 2. Normally it's at 4, so that's really like a 6% discount. Let's see. That's annual. I haven't looked at the annual DSL. General discount, DSL has the better discount, but general pricing, DSL has the most room to gain back to its normal range. And normal is bumpy and like, that bump in the road as we go. But also DSL, I guess the third would be DSL gives me a better dollar cost average in the grand scheme of things. But any four would be fair game. Now, IGR is a dollar cost average move. So if we're going on straight discount, it wouldn't apply. But on my end of things, IGR, my average buy price for IGR is close to 544 a share. So to pick up, I mean, any subset, 100, 200, 300 shares of that would significantly draw down my average buy price. And that's why IGR stays on this list. Outside of that, if we're prioritizing the discount to net asset value, IGR does not remain on the list, but the other three would. So take that for what you will. Um, let's see. What advice can I impart to you going forward? Let me put it like this. Most investors are trying to predict what happens next, but that's the wrong game. The better question is, where is the market already going? And how do I get there first? Maybe how do I get there ahead of the herd, which would still be first? Right now, the answer isn't flashy. It's not exciting. It for sure isn't popular. It's not trendy, but the data keeps pointing in the same direction. And eventually, the market follows the data. And where is that? That's bonds. Bonds are just there. It's not AI, it's not tech, it's not anything. It's just bonds. So I would still prioritize bonds. That's DSL and PDO this week. You could argue for the bond proxies, IGR on my end of things based on dollar cost average move. If you don't own it, then it's kind of hard to argue that position. And HGLB is really the lowest been in a considerable amount of times. It's a bond proxy. It meets some of those other boxes. It's end to end energy, its technology infrastructure between its midwave wireless component and its data center component. And it does have a small contingency of bonds. So that's all I have for the week. I wish you a great week. I wish you a successful week. On my end of things, things have been incredibly busy. I'm hoping for time to truly, maybe not slow down, but at least feel like I have room to think and process. And that's really what I've been lacking. So on my end of things, I'm hoping for a smoother week where I can get more done. And I wish you a productive week and a successful week. And whatever you have facing, I hope it goes well for you. So have a great week, everybody. I will see y'all next weekend. Bye bye.